Howdy, Jacob here. Today we're looking at Kimbell Royalty Partners. So 13.2% dividend yield looks absolutely fantastic from that perspective. $1.6 billion market cap, $1.85 billion enterprise value. So not too much net debt there. It looks like the company engages in acquiring and owning mineral and royalty interests in oil and natural gas properties. All right, so the debt, long-term debt was 9 million in 2014 and is now 233 million. What is that to their cash flow? So last 2022 was about 26 million, and then 2021 35 million, negative in 2020, and then a positive 68 million in 2019. I mean, the first thing I'm seeing is that I think if we're being generous, their 5 year average, let's do a 4 year average excluding 2018, is a 40 million, and they're paying out 139 million in dividends. So I would say, I mean, 140, they divide that by 7, and you're looking still at a 20 million payout, which still seems to be a lot. So I okay. So instead of issuing, they have issued debt, but instead of issuing a lot of debt, they've been issuing a lot of shares to make up for being able to afford the dividend. The only thing is, the more shares you issue, your your dividend is on a per share basis. And so if you have a, like what they have, a $2.04 per share dividend, the more the more shares they issue, the more expensive from an actual cumulative dollar standpoint it's going to be. So for companies that um, want to pay out the same amount, and if they were a no growth company, all you'd have to do is buy back a little bit of shares, and then that dividend, that per share dividend, actually increases. But in this case, they're issuing more shares and increasing the dividend amount because their shares are also going up. And so, I mean, all this combination, when I look at this cash flow statement, is just not attractive whatsoever. It looks like, the more they made in cash from operations, the higher their capital expenditures were. In the last 12 months, capital expenditures of 631 million compared to 150 million in cash from operations. I mean, I can get to the assumptions now. Let's say they cut this by 7, it's still 20 million payout. Revenue change, they've grown a lot recently, but in the oil, gas, consumable fuels industry, I would say 0%, 10 on the P, price to free cash flow, 15% return. And as for margins, I mean, maybe let's say 20, 10. They've been increasing shares like crazy, though. So let's assume 10% share issuance. Um, with all that said, I mean, I can bring this down to 5 because this is assuming they cut their dividend by 7, which means they wouldn't have to fund their dividend through issuing shares and issuing debt. So that's why I minimize their share change quite a bit lower than what you see historically. But even still, generously, it has to fall 72% to get to a price that's going to give us 15% return. I mean, for now, I'm just waiting. The numbers itself, when I looked at the cash flow statement, were very unattractive. They issued a lot of stock and issued a little bit of debt to be able to fund a dividend that they can't afford. And so it should be pretty simple review when you're looking at dividend companies. You really want something that has very promising cash from operations, a low payout, and are able to afford it from a debt perspective on the balance sheet. And I mean, it looks like they're just issuing shares and issuing debt to be able to fund the dividend, which is not something you want in your portfolio if you really want a dividend that's going to stick no matter what. So that's my review of Kimbell Royalty, and I hope everyone has a good rest of the day. Thank you.